I'm Karl Pemberton, Managing Director of Active Chartered Financial Planners. When it comes to end of tax year planning, it's important not to forget the basics. This includes making the most of ISAs, pensions, capital gains tax allowances and inheritance planning. Most people are aware that they have an ISA allowance, but not everyone is aware that if you don't use it, you lose it. The current ISA allowance is £15,240 for the 2016-17 tax year. This can be saved into either a cash ISA, stocks and shares ISA, or a combination of the two. It's worth noting that stocks and shares ISAs do not include the same security of capital that cash ISAs do. If you are going to save into one, make sure you seek financial advice, as these investments will rise and fall. In the next tax year, starting in April, you will have a new ISA allowance of £20,000. This year also sees the introduction of the new lifetime ISA. The lifetime ISA will be within your overall £20,000 limit, along with all payments into other types of ISA. The rules for a lifetime ISA, which are yet to be finalised, are that you should have to be aged 18 to 40 and should be saving for either a house purchase or retirement. If this is you, then the allowance is £4,000 and you will receive a 25% bonus from the government on top. This means if you contribute the full allowance of £4,000, you will have £1,000 added to your savings. This bonus is paid until you turn 50. If you are using the funds for retirement, you are unable to access these until your 60th birthday. If you do withdraw funds for something other than retirement or buying a house, you will lose the 25% bonus. The rules here are complicated, and you should consider whether this is more suitable than other alternatives such as ISAs or pensions. As well as your ISA allowance, you also have a pensions allowance. You are able to pay up to £40,000 into your pension each year, if you have earnings of at least £40,000. If you have no earnings, you are still able to pay up to £3,600. Your employer can also pay into a pension on your behalf, but your tax relief on this works slightly differently. In short, a pension can be a tax-efficient way to save for retirement. Another way to plan is the inheritance tax gifting allowance. You have an allowance called the nil rate band. This is the amount you can leave behind when you pass away without paying inheritance tax. This is currently £325,000, but if you are married, you may be able to inherit a deceased spouse or partner's allowance, thus effectively doubling to £650,000. Above this, your estate will be taxed at 40%. However, as with ISAs and pensions, you do have options. You can gift up to £3,000 per year, which is doubled if you did not use it last year. This allows you to reduce the size of your estate, which will cut the amount of inheritance tax due on it. If you do not make use of your allowance and make gifts, these can potentially remain in your estate for another 7 years. However, if you make large gifts, you may suffer an immediate tax charge. It is also important to consider your capital gains tax allowance. This currently is £11,100 per tax year. The basic rate is 10% and the higher rate is 20%. Even higher rates can apply in certain situations, such as the sale of residential property, but not your main residence. You only pay tax on the excess over your allowance, and there are some gains which are tax-free, such as selling your main residence or a car, for example. If you need to make a large disposal from an investment near the end of the tax year, you may be able to make a partial withdrawal, drawing part in the current tax year and part in the next one. This would use both years' allowances to minimise what you pay. To speak to an expert about your end-of-year tax planning, contact the Active Chartered Financial Planning team today.